Welcome to The Explainer. Today we're unpacking the Enbridge Stock Analysis 2026 Deep Dive by Save Invest Compound. If you're an income investor, you definitely know this North American energy titan. I mean, it's sitting on a juicy 5.24% forward dividend yield. But the big question we're trying to answer today is this: does this dividend giant actually belong in your long-term portfolio at its current price? Well, let's look at the numbers and find out. To do that, we'll step through a structured analyst framework. We're going to cover the business model, the moat and financials, intrinsic value and mispricing, risks and scenarios, price targets and scores, and then finally, we'll wrap up with the final verdict. All right, Section 1, the Enbridge business model. Let's look at exactly how this company makes its money. So Enbridge operates a massive, honestly irreplaceable network of energy infrastructure all across North America. We're talking crude oil pipelines, natural gas transmission systems, gas utilities, and even some renewable energy assets. But here's the absolute most important thing you need to understand about their business model. They primarily earn their money through toll-like arrangements. Think of them as the ultimate toll booth operators of the energy world. Customers pay fees to move products through their pipes, and this is usually under long-term agreements or regulated frameworks. Why does that matter so much? Because it heavily insulates Enbridge from wild commodity price swings. Oil prices could literally collapse tomorrow, but as long as volumes remain relatively stable, Enbridge's pipelines are still churning out revenue. They act way more like an infrastructure utility than a conventional energy producer. And hey, with the massive rise in North American electricity demand, driven by AI and electrification, their natural gas and utility segments are perfectly positioned for steady growth. Moving on to Section 2, Moat, Financials, and Management. Let's look at their defenses and the raw numbers. When digging into their moat, what really jumped out at me is that the sheer scale here is staggering. Replacing their network would require tens of billions of dollars and decades of red tape. Actually, ironically enough, strict environmental regulations act as a massive barrier to entry here, totally protecting Enbridge from new competitors. The deep dive also highlights that management is highly competent and very much aligned with income investors through a rock-solid commitment to the dividend. So on a qualitative level, you're looking at a highly durable, slow-growing, long-term infrastructure compounder. But take a look at this incredible tug-of-war playing out right now. On the left side of the scale, you have amazing stability. 65.2 billion Canadian dollars in trailing 12-month revenue, generating a massive 12.27 billion in operating cash flow. The profitability is exceptionally solid. But dropping onto the right side of the scale is an absolute anchor of debt. We're talking $105.3 billion, which pushes their debt-to-equity ratio up to a lofty 161%. Add in $9.17 billion in capital expenditures just to maintain and slowly grow the business, and you can quickly see why this massive leverage is the #1 concern for potential investors. Okay, Section 3, Intrinsic Value and Mispricing. What is this company actually worth? The 2026 Save Invest Compound Deep Dive calculates a blended intrinsic value for Enbridge. So how did they get there? They averaged two different methods. First, they ran a conservative discounted cash flow model, assuming 5% growth and an 8% discount rate. That gave a value of $68. Second, an EBITDA multiple approach gave a value of $71. Blend those two together, and you get our magic number, exactly $68.50 Canadian. But here's where we hit a bit of a snag. With the stock currently trading up around $73, investors are facing a negative 7% margin of safety. Basically, that means you're actually overpaying for its true value today. Why is that happening? Well, the thesis is that the broader market is treating Enbridge almost like an infrastructure bonds. Because that 5.24% yield is so dependable, investors are just happily paying a premium for that safety in an uncertain market rather than demanding a discount. Let's transition into Section 4. Risks, SWOTs, and scenarios. We need to map out the overall safety and risk profile. This weighted SWOT analysis, strengths, weaknesses, opportunities, and threats, brilliantly illustrates that ongoing tug-of-war narrative we just talked about. Notice how Enbridge scores incredibly high, 9s out of 10 for its ironclad infrastructure moat and stable cash flow. But those strengths are heavily offset by scores of just 4 and 5 in categories like high debt, regulatory risk, and energy transition threats. When you weight all of that out, the total score sits at 6.75 out of 10. It shows us that Enbridge is a solid, but maybe not exceptional, investment in its current state, because that massive leverage meaningfully constrains the upside. When we scan the horizon for specific red flags, the deep dive flags 3 major issues for long-term investors to keep a close eye on. First, there's a history of serial acquisitions. Now, while this does grow the company, it's exactly what has pumped up that massive debt. Second, because of that debt and higher interest rates, Enbridge's interest expense has climbed significantly. It's now hitting a staggering $5 billion over the trailing 12 months alone. Guys, that is a lot of cash going straight to the bank instead of your pocket. Finally, the heavy capital expenditures required literally just to run the business severely suppress the actual free cash flow left over for shareholders. Because of all these moving parts, we need to look at a few different future scenarios. In a bear case, driven by higher interest rates, compressing valuations, and slowing down dividend growth, the intrinsic value drops to $52. The base case, which assumes a steady 4 to 5% cash flow growth, brings us right back to our 68.50 valuation. But what about the bull case? That shoots all the way up to $88. This could happen if interest rates drop and natural gas demand absolutely surges thanks to AI infrastructure and grid electrification, which would prompt investors to pay premium multiples for Enbridge's incredibly stable yield. Let's look at Section 5, price targets and scores. Let's get into the exact numbers you need to know. The deep dive calculates two final scores to really summarize the whole investment picture. First, we have a risk score of 6.45 out of 10. This indicates a moderate risk. Essentially, the extreme stability of their utility-like cash flow offsets the sheer massive size of their debt burden. Second, we have an opportunity score of 6.9 out of 10. The main takeaway here is absolutely crucial. Enbridge is a very good long-term compounder company, but the current premium valuation severely limits your upside asymmetry. Basically, it might not be a great stock price to buy in at right now. So, what should you actually pay? Well, this table is honestly like a cheat sheet for your portfolio. The analyst's goal here is a 9% average annual return over 16 years, which is effectively a 300% profit. It shows exactly what price you need to pay today to hit different annual return targets over that specific 16-year horizon. If you're happy with a 6% annual return, you can buy it today around $73. But if you want that juicy 9% target return, you need a much wider margin of safety. You need the price to drop down to $55 to confidently lock in that kind of yield and growth combination. And we can actually slice this data another way based on your personal time horizon. Let's say we lock in that 9% annual return goal, but we only plan to hold the stock for 5 years. As you'll see, you're going to need an even steeper discount, down to $48. The longer you can hold this infrastructure compounder and let those dividends reinvest, the more you can afford to pay up front. So for a 16-year hold, $55 is your magic entry point. Finally, Section 6, the final verdict. Let's wrap up these key takeaways. Ultimately, the Save Invest Compound analysis concludes that Enbridge remains one of the highest quality infrastructure businesses in Canada, hands down. It has incredibly durable assets and highly reliable dividends. However, at current prices around $73, it's fairly valued to maybe even slightly expensive. It's a really solid hold for existing investors who are already enjoying that excellent 5.24% yield. But for new money, the smart, patient investor should probably keep their powder dry and wait for a broader market correction, or maybe rising interest rates to pull the stock back into an ideal buy zone of $55 to $60. I really hope this data-backed breakdown helped clarify Enbridge's true value for you. Honestly, it leaves us with a fascinating question to ponder. Is chasing a safe 5% dividend yield really worth weathering over $100 billion in corporate debt? I'll let you decide on that one. So, which stock do you want me to analyze next in our Explainer series? Let me know right down in the comments.